Imagine it is the morning of December 3rd, 2001. You're a 43-year-old bank branch manager living in Buenos Aires, Argentina. Your apartment is on a quiet street in the Palermo neighborhood, close to the park where you walk every Sunday. You have spent 20 years building a life that looks, by every measure, like a success. You drive a modest car. You own your flat. You have 38,000 US dollars saved in the national banking system. The same system you have worked inside for 2 decades. You trust it the way a sailor trusts the hull of a ship. You trust it because you helped build it, one customer at a time, one deposit slip at a time. Your daughter starts university next year. Your wife is talking about a small vacation. You go to bed on the night of December 2nd, feeling the quiet satisfaction of a man who has done everything right. You wake up on December 3rd to news that the government has just frozen every bank account in the country. The measure has a name. They call it the corralito, the little corral, as if your life savings are cattle that have now been penned in by someone else. Overnight, you cannot withdraw more than 250 pesos per week. In weeks that follow, the peso itself will collapse. The currency that was worth exactly $1 the day before will soon be worth less than 30 cents. Your $38,000, measured in the new exchange rate, will be handed back to you in pesos worth less than $12,000, and you cannot even get to it. The gates are locked. The system you spent your career maintaining has just swallowed everything you gave it. If you have ever wondered why some people walk out of economic disasters with more than they walked in with, while everyone around them loses everything, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before, in different countries, in different centuries, in different languages, and it always ends the same way. The people who understood which assets truly hold value during collapse did not just survive. They came out ahead. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Because the story of Buenos Aires in December 2001 is not an Argentine story, it is a human story. And it has been told before in Germany, in Zimbabwe, in Lebanon, in Venezuela, and in dozens of places in between. The assets that exploded in value while everything else burned are the same ones, every single time, 5 of them. And understanding why requires understanding something that most people spend their whole lives never thinking about. Before we go further, there is something important to understand. When an economy collapses, what is actually happening is not complicated. The complicated part is the machinery that hides it for years before the moment arrives. But the collapse itself is simple. It is a question of trust. All paper money, all bank accounts, all financial instruments are ultimately promises. A banknote is a government's promise that this piece of paper represents real value. A bank deposit is a bank's promise that your money is there when you need it. A pension is a government's promise to pay you in the future. When those promises break, everything built on top of them breaks too. Think of it like a building where every floor is made of paper. While conditions are calm, paper floors hold weight. But introduce the right kind of pressure and every floor collapses onto the one below it. What survives? Only what was never made of paper to begin with. Only what has weight and substance that does not depend on any institution's willingness to honor a piece of paper. This is the secret the history of collapses has been trying to teach us for 500 years. Not paper, real things, specific real things. And the historical record identifies 5 categories of these assets with remarkable consistency across every major collapse of the last 100 years. This brings us directly to the first one, and to the most dramatic economic story of the 20th century. It is 1923, Germany. Not the Germany of gleaming cities and orderly banks that people think of today. This is a Germany stumbling through the wreckage of World War I, drowning in war reparations it cannot pay. Its government doing the only thing desperate governments do when they run out of money. They print more of it. At first, the printing feels like a solution. Prices rise, but the economy keeps moving. By 1921, inflation is rising, but it still feels manageable. By 1922, it is bad. And then something shifts. The printing accelerates. And what was bad becomes something that has no polite word for it. Hyperinflation. That means prices rising so fast that by the time you get home from the market with your change, the change is already worth less than when the shopkeeper handed it to you. By November of 1923, one single US dollar was worth 4,210 billion German marks. That is not a typo. 4,210 billion. The kind of number that stops being a number and becomes a hallucination. Workers were being paid twice a day so they could spend their wages before they became worthless by evening. Wheelbarrows of cash were used to buy a single loaf of bread. And this was not happening to poor or uneducated people. This was happening to doctors, professors, engineers, and civil servants. The middle class of one of the most educated nations on earth was being systematically erased, not by war, not by disease, by the collapse of the thing they had trusted to hold their life's work, paper currency. Here is what the history books rarely tell you about Weimar Germany, and it is the most important part of this story. Ordinary German citizens who had converted any portion of their savings into gold before the collapse did not just survive. According to historical analysis of that period, someone holding gold during the Weimar hyperinflation actually saw their real purchasing power increase by nearly double. While a German saver who kept 1,000 marks in a bank account watched it become worthless within months, a German saver who had exchanged those marks for a small amount of gold preserved not just their wealth, but grew it in relative terms. Because gold does not care what a government prints. Gold has no nationality. Gold cannot be created by a printing press. It is not a promise. It is a thing. A heavy, impractical, beautiful, ancient thing that has functioned as a store of value across every civilization that has ever existed on this planet. The mechanism is not mysterious. When the currency supply explodes, but the supply of real goods and services does not, each unit of currency buys less and less, but gold is priced in that same currency. So as the currency becomes worth less, the price of gold in that currency goes up. Not because gold became more valuable, but because the yardstick shrunk. A meter is always a meter even when the ruler changes. And gold is one of history's most reliable meters. The same pattern appeared in Zimbabwe in 2008, when inflation reached an estimated 231 million%, 231 million. The Zimbabwean dollar became so worthless that the Reserve Bank of Zimbabwe eventually issued a $100 trillion note, not a useful denomination. Those who had access to gold, or to a small number of gold coins stored physically, walked through that catastrophe. While their neighbors counted zeros, that meant nothing. Now here is something I want you to think about before we go further. If you found out that your bank could freeze your account tomorrow, and every dollar inside it could be converted into a fraction of its value by government decree, what would you do differently starting today? Drop your answer in the comments, seriously. Because what I am about to show you next is the part of this story that most people never hear. And it changes everything. This leads us to the second major asset. And to return to Argentina, because Argentina teaches this lesson with a specificity and a human brutality that is hard to match. The year is 2001. We already met our bank manager from Palermo, but not everyone in Buenos Aires woke up that December morning equally trapped. There's another man in the same city, a 57-year-old mechanic named Ernesto. He does not have a bank account with $38,000 in it. What Ernesto has, hidden in a shoebox inside the wall of his workshop in the working-class neighborhood of La Boca, are $4,000 in cash. Not pesos, dollars, green paper from a foreign country's government. He saved them slowly over 10 years, not because he was sophisticated, not because he had studied economics, but because his father told him never to trust the government with his savings. And his father had lived through a previous Argentine inflation crisis in 1989 when prices rose by 3,000% in a single year. So Ernesto saved in dollars, and he kept them in the wall. When the Corralito hit, Ernesto watched his neighbors panic at the bank doors. He watched the television and saw the scenes of middle-class Argentines banging their pots in the streets in the famous Cacerolazo protests. He watched the peso float free of the dollar peg and fall, and fall, and fall. The peso depreciated to nearly 4 pesos per dollar before it partly recovered. What that meant in practical terms is devastating to think about. The savings that a peso holder had were now worth roughly 1/3 of what they had been worth 3 months earlier. But Ernesto's $4,000, now converted into pesos at the new exchange rate, were worth roughly 12,000 pesos instead of 4,000. His purchasing power in the local market had tripled. Not because he was lucky, because he had held an asset that was not subject to the decisions of the Argentine government. The BBC reported that when Argentina eventually defaulted on a debt of $132 billion, poverty in Gran Buenos Aires reached 50%, half the population. And the people who came through it holding the most were those who had hard foreign currency outside the reach of any domestic institution. This is the second asset. Hard foreign currency, preferably held physically, outside the banking system of the collapsing country. And this is not a permanent strategy for normal times. In normal times, holding cash in your mattress is a terrible idea that earns no return and slowly loses to inflation. But in collapse, the rules invert. What was a bad idea becomes a lifeline. And the people who had it were not wealthy speculators. They were ordinary people who had learned from their parents and grandparents that the government's paper is only as good as the government that prints it. The same pattern appeared in Lebanon between 2019 and 2021. Lebanon's economy contracted by more than 50% in just 2 years. The Lebanese pound lost over 90% of its value. Banks froze approximately $93 billion in deposits. $93 billion. Regular Lebanese families went to their bank branches and were told they could withdraw only small controlled amounts per month, and only in Lebanese pounds, not in the dollars they had deposited. Those who had kept US dollars physically at home, a practice so common in Lebanon that it has its own local slang, These people maintained their ability to buy food, medicine, and necessities, while their neighbors with bank accounts were effectively trapped. A country's banking system is not a vault. It is a promise. And in Lebanon, that promise was broken in the most complete way. Now here is where it gets interesting. Because the third asset on our list surprises almost everyone when they first hear it. And it requires a trip not to a collapsing hyperinflationary economy, but to the United States of America in 2008. The global financial crisis that began with the implosion of the U.S. housing market and the collapse of Lehman Brothers on September 15, 2008, sent shockwaves through every asset class. The S&P 500, which is the measure of America's 500 largest companies, fell by 57% from its peak. Home prices across the United States fell by more than a fifth on average. Trillions of dollars of paper wealth evaporated. Pension funds were decimated. And yet, while all of this was happening, one asset class in America was quietly telling a completely different story. Farmland. Agricultural land, the kind of soil that grows food, not stocks, not bonds, not commercial real estate, farmland. According to data from the USDA and the Kansas City Federal Reserve, U.S. farmland values not only held up during the 2008-2009 recession, they continued to rise. When the housing market was in free fall, when commercial real estate was losing value across the board, farmland prices remained resilient, and in many regions of the American Midwest, continued to appreciate. Farmland prices were estimated to have increased at more than 7% in 2010 and 2011, reflecting the continued strength of farm income even as the broader economy struggled. By the time 2008 was fully processed by history, farmland had risen by roughly double from its 2003 values, and it barely paused to acknowledge the crisis that brought every other asset to its knees. Why? The mechanism here is different from gold and hard currency, but the underlying logic is the same. Land that grows food is a productive asset. It generates something real. Not a financial return dependent on market confidence, not a yield dependent on a bank's solvency. Actual food, corn, wheat, soybeans. The kind of things that human beings need regardless of what the stock market is doing, regardless of what the government decides to do with interest rates. Farmland is a claim on the Earth's productive capacity, and the Earth does not file for bankruptcy. Warren Buffett, who has spent his career looking for this quality in investments, has said that productive assets are the foundation of real wealth. Farmland is perhaps the most literal example of that principle. It converts sunlight and soil into goods that people need unconditionally. And because people always need food, even in the worst possible economic conditions, the land that produces it maintains a floor value that no amount of financial chaos can remove. The same pattern is visible in every major economic disruption, going back through the Great Depression of the 1930s and beyond. During the stagflation period of the 1970s in the United States, farmland values rose dramatically alongside the broader inflation. They did not fall during the recessions of 1973 to 1975, 1990 to 1991, 2001, or 2008 to 2009, according to historical records from the Federal Deposit Insurance Corporation. Yes, farmland did experience its own crash in the 1980s, during the specific farm credit crisis of that decade, and that is important to understand. But that was a crisis caused by excessive leverage and overvalued farmland itself, not by a currency crisis or a banking collapse of the type we are examining. When the threat comes from outside the agricultural sector, farmland is among the most resilient assets in history. Most people will never know what you now know. Most people will keep trusting systems they do not fully understand, putting their faith in numbers on a screen that represent promises made by institutions they have never visited. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in the textbooks. Now observe what all of these cases have in common. In Weimar Germany in 1923, the asset that held value was gold, something that cannot be printed, cannot be created, something that has weight and reality independent of any government's decision. In Argentina in 2001 and Lebanon in 2019, the asset that held value was hard, foreign currency held physically, something that belonged to a different government's promise, and therefore was insulated from the specific government that was failing. In the United States during 2008, the asset that held value was farmland, something that produces real goods that human beings need unconditionally, independent of financial markets. The same mechanism, different countries, different decades, different flavors of collapse, same result. The assets that survived were those whose value did not depend on any institution's continued willingness or ability to honor a paper promise. This is not a coincidence, it is a structure. Economic collapse is not a random disaster. It is a specific failure of trust in specific systems. And the assets that are outside those systems, or that exist independent of them, are the ones that absorb the energy of the collapse rather than being destroyed by it. Think of it like a wave. Paper assets are a sandcastle. The wave destroys them completely. Hard assets are a reef. The reef does not move. This brings us directly to the fourth and fifth assets on our list, and to the part of this story that gets the most uncomfortable. Because what happened to ordinary people in these collapses, at the level of daily human experience, is the part that most history books skip over in their rush toward the macroeconomic analysis. Let us go to Venezuela. The year is 2017. Inflation is rising at over 4,000%. By 2018, it will reach an estimated 1,700,000%. 1.7 million% annual inflation. A salary that was enough to buy a week's groceries in January 2017 was not enough to buy a single meal by December. Supermarket shelves were bare, medicine was rationed. Doctors, engineers, teachers, and scientists were leaving the country at a rate of hundreds of thousands per year. The economist Eulogio Chacon Moreno, a respected ecologist with a university career, fled Venezuela during this period because his salary, denominated in bolivars, had become functionally worthless. His profession, his credentials, his savings in the local currency all evaporated together. But there were people who did not flee. And there were people in Venezuela who were doing the trading of US dollars for bolivars that allowed everyday commerce to function at all. Informal businesses, small shops that accepted dollars or stablecoins, which are digital currencies pegged to the dollar's value. People who had skills that people needed regardless of the economic environment. Mechanics, electricians, medical personnel who operated clinics on a cash dollar basis. Farmers who could grow food and sell it directly. Small business owners who traded in essential goods and could price them in hard currency. Venezuela eventually ranked 13th globally in cryptocurrency adoption per capita, largely because ordinary people had figured out that the US dollar, even if accessed digitally through stablecoins, was the only reliable unit of account left in their economy. Skills and productive small businesses serving essential needs had become, functionally, the most valuable assets a person could hold. Because they generated real income in the only currencies that still worked. This is the human cost pattern that repeats in every major collapse. Middle-class savers, the people who did exactly what they were told to do, who put their money in banks, who bought government bonds, who saved in the national currency, these are always the people who lose the most, not the wealthy, not the connected, not the people with assets outside the system. The ordinary people who trusted the system most completely. In Zimbabwe, in 2008, pensioners who had spent 40 years saving in Zimbabwean dollars watched their entire life savings become worthless within months. They had done everything right. They had saved. They had been responsible. And the system they had been responsible inside simply stopped working. In Argentina, estimates suggest that poverty in Gran Buenos Aires reached 50% in the immediate aftermath of the 2001 collapse. Half the population. Not because those people were reckless, because they were inside a system that failed. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it coming before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. At this point, the pattern becomes impossible to ignore. And so the question that every thoughtful person watching this will now be asking is, what did the people who came through these collapses actually do? What specific characteristics did the survivors share? The historical record is surprisingly consistent on this, and it can be described without making predictions or giving financial advice, because these are observations about the past, not prescriptions for the future. The historical record shows that those who came through these periods largely shared three characteristics. First, they held a portion of their wealth in assets that exist outside the financial system of the country in question. This could be physical gold, it could be foreign currency held physically. It could be land, it could be a productive skill or business generating real goods or services. The common thread is that these assets did not require the domestic banking system, the domestic currency, or the domestic government to remain functional in order to retain their value. In every case study we have examined, the people who lost the most were those who were 100% inside the system. The people who lost the least were those who had at least a portion of their holdings in something real, something physical, something productive. Second, the survivors were typically those who had separated at least some of their financial life from the institutions that failed. This does not mean they predicted the collapse. In most cases, they had not. The Argentine mechanic Ernesto did not know the Corralito was coming in December 2001. He had kept dollars in his wall for 10 years, a family habit rooted in a previous crisis. The Lebanese families who kept US dollar bills at home were not financial analysts. They were people whose cultural memory of previous crises had taught them a lesson that their government had not. History is the most expensive teacher in the world, but its lessons, when inherited, can protect people at no cost at all. Third, and most counterintuitively, the survivors were often people who provided or possessed genuine productive capacity. The mechanic, who could fix an engine, the doctor who ran a private practice, the farmer who grew food, the baker who made bread. In the worst of these collapses, formal economy currencies and financial instruments failed, but the exchange of real goods and real skills never stopped. In Zimbabwe and Venezuela, informal barter economies and dollar-based street markets emerged and functioned, while the formal banking system was in various stages of collapse. The people who were inside those real economies, not the paper economy, were the people who kept eating, kept operating, kept surviving. None of this is a recommendation for what anyone should do today. Every individual's situation is different. The historical record is not a financial plan. It is a map of the past, not a compass for the future. But what it shows us, with remarkable consistency across a century and dozens of countries, is that the assets that survived every collapse were not the ones that were most sophisticated. They were the ones that were most real. Now let us come back to Buenos Aires, to the apartment in Palermo, to the bank branch manager we left standing on the wrong side of the Corralito in December 2001. What happened to him? The historical record of Argentina's crisis tells us what happened to most people in his position. The $38,000 in the banking system were eventually released in pesos at the new, deeply devalued exchange rate. Depending on the timing, many Argentines received back roughly 30 to 40 cents on the dollar. His life savings of $38,000 may have come back to him worth roughly $12,000 to $15,000 in real terms. Years of work, gone, not because of fraud, not because of crime, because of a system failure that economists and government officials had been quietly watching develop for years while telling the public that everything was fine. The cracks had been in the foundation for a long time. They always are. The floor gives way suddenly, but the rot is always in the beams, not on the surface. This is the most important lesson of every economic collapse in history. The visible moment of crisis is rarely the beginning of the crisis. It is the culmination of a long, slow, invisible deterioration in the reliability of the promises the system is built on. 5 assets: gold, hard foreign currency held outside vulnerable institutions, farmland and productive land, essential skills and small businesses serving real human needs, and finally, specific types of real estate, the kind that is owned free and clear, that is denominated in hard currency, and that provides essential shelter in the physical world. These are not new ideas. They are ancient ideas. They predate banks. They predate paper money. They are the assets that human beings reached for in every era of history when the sophisticated financial machinery of their time broke down and revealed itself to be made of paper and promises. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified financial professional before making any financial decision. The purpose of this video is to understand history, not to prescribe action. This video is not for everyone. Most people will see the title and scroll past it. Most people will keep trusting systems they do not fully understand, and in the good years, that will be fine. But if one person in your life is asking the right questions right now, the questions about what is real and what is made of paper, share this with them. Not because it will change the world, because it might change their world. Subscribe for more of this kind of historical analysis, and I will see you in the next one.